And now for something completely different.
It's a rich world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. It's the Hump Day edition of the Real Investment Show. Of course, that means Danny Ratliff joining me this morning. And we'll be touching a little bit about, this morning, mask mandates potentially coming back. What does that mean for the economy? The whole COVID vaccine, issue kind of went away here for a little bit. Now it's starting to come back. What does that mean for the markets? I mean, even conversations now potentially out of the White House about maybe going back to shutdowns. Can't imagine that would be the case, but we'll certainly talk about that a little bit more this morning as we kind of get into the show. But I do want to kind of catch you up on what's happening with markets overnight because, again, this is super big earnings week for the S&P 500. And as we've been talking about here for the last few days, the markets had a tremendous rally here after coming down, touching the 50-day moving average. We had a very sharp surge in the S&P 500 in particular and the NASDAQ as retail investors. In fact, if you take a look at the flow of retail investors and what they did, there was a huge buying spree by retail investors coming off that 50-day moving average. So again, not surprising here, markets have had a little bit of lift here going into earnings season. ETF flows this year, so the exchange traded funds. So through the first half of this year, there have been more money being poured into exchange traded funds than ever before in history. Now, part of this is people moving out of actual mutual funds into ETFs, but outside of that, there's also been a tremendous amount of inflow actually going into ETFs. So the point is there's a lot of people chasing this market. So this market continues to kind of elevate higher. We've talked about yesterday with respect to the next Minsky moment. What happens when you have a lot of QE and easy credit is that leads to speculative booms in markets. Of course, we've talked about this for a while. And again, low volatility periods, as we said yesterday, tend to lead to higher volatility periods. But right now we're in a low volatility period, which means that there just really isn't a lot of concern about the markets. But that also, starts to provide some challenges. As an example, we've got some really good earnings. Last night, Apple reported really kind of blowout earnings and across the board, beating both top and bottom line. Have had a big pickup and a spike for demand for phones as people are kind of getting back out into the world of working and getting their things together. But Apple's very extended from their 50 and 200-day moving average. So as a function of that, I mean, there's only so far that prices can rise, and prices ran up into earnings. And so despite the fact that they had really good earnings, not getting really paid a whole lot for that. In fact, Apple's expected to open down just a little bit this morning. So again, a lot of the good news, so to speak, has already actually been priced into the markets. But it's not just Apple. Amazon as well has been, kind of very elevated here above long-term moving averages, very extended. Got earnings coming up on that. Also, Microsoft reported earnings yesterday, beat on top and bottom line. I'll spit that out. But again, the extension of these particular FANG stocks in general are so elevated above long-term means that you're eventually going to get a reversion of that mean. But what this also suggests is that most of the good news is already baked into the earnings announcement. So as these companies are announcing really good earnings, most of the price run has already been built into this. Google's going to be up today at the open, but not a whole lot. Had fantastic earnings, but the stock will be up here a little bit this morning, mostly just kind of recovering yesterday's sell-off. But again, massive extensions from long-term moving averages. So again, the eventual correction back to the longer-term means is going to be significant at some point. But again, that's down the road somewhere. Right now, earnings are good, expectations are good, outlooks are strong, and of course, corporate margins, and particularly when people are taking a look at profit margins, corporate profit margins are very, very strong right now. And this is because of the effect of the shutdowns, right? So talking about COVID and the shutdowns that we did, this was actually very good for corporate bottom lines because they were able to reduce work staff, right? Labor costs are some of your highest costs of running any business. Also reducing office space. A lot of offices got shut down. A lot of space got shrunk because people are working at home. And then corporations also went out and spent a lot of money on technology, which has been boosting companies like Apple and Microsoft, because they started transitioning more to technology to reduce the demand for labor. This has all been huge benefits to corporate profit margins. And in fact, over this last really kind of 4 reporting periods since we've gone through COVID, corporate profit margins have just simply exploded for a lot of these companies. So they're not creating any more revenue growth. Revenue growth at the top line remains exceptionally weak. In fact, revenue growth for this quarter will actually be less than it was last quarter, despite the fact that we're having record earnings so far. We're seeing slower rates of revenue growth at the top line. Well, this is because people don't have any money to spend, right? They're out of work, they're at home, they're living on what they've got. Wages really aren't growing that much, so it's hard to generate more revenue at the top line when wages aren't really growing with the economy. But when you have all these other cost-cutting benefits and measures, corporate profit margins get very juicy very quickly. So that's really what's been going on here. But here's the point about what we're saying is that we're right in the midst. This is the heart this week of earnings announcements. McDonald's out this morning, double-digit beat on their top and bottom line. Stock's not really getting rewarded that much. Why? Because, well, it's already been priced into the markets. And that's one of the challenges that we're going to continue to kind of work through here over the next few weeks is this really kind of as good as it gets for the markets? I mean, you're getting very strong earnings growth. This is the peak of economic growth for sure. And as we see really kind of earnings growth, economic growth start to fade over the rest of this year. In fact, I've got an article coming out on this on Monday. We're already starting to see that peak of economic growth, which will also translate into a peak of earnings growth. So earnings growth that rate of growth. Now, earnings will still grow. The economy will still grow. It's just the speed at which it grows will start to slow down rather markedly over the course of the next couple of quarters. So for stocks in particular, if they're not getting rewarded now for the rate of earnings growth that they're getting, this has become a bit more problematic as we start to move out into the next couple of quarters of the year. But again, we're long these stocks as well in our portfolio. Apple, Microsoft, Google, we own these companies. We took profits in Apple just a few days ago, really just right here before the announcement. We were a little bit concerned about them potentially meeting earnings because of the fact of chip supply shortages, et cetera. And that's going to be one of the things that weighs on Apple here in particular going out over the next couple of quarters is going to be a shortage of chips, again, to create Apple iPhones. We also took profits in Microsoft as well. Stocks just had a huge run up here. And again, even though their earnings were good, there's not a lot of upside benefit here in Microsoft at this point. Again, still long the position. We just took in some of our profits because of this really accelerated run. Same thing for Google as well, as we take a look at these companies, because as we, again, to look at just some of these extensions from long-term means, as I said before, just made sense to bring in some profits, kind of rebalance the portfolio here a bit in particular, because these are very, big stocks. They're very liquid. This is where money's hiding right now. But if there's a reversal in the market, this is also where that will eventually show up here over the next couple of months. So again, just a little bit of risk management in portfolios, really nothing more than that. But when we come back from the break, we'll pick up with Danny Ratliff. We'll get into this whole, COVID issue potentially. What does that mean for markets? What does that mean for profitability? What does that mean for your money? Talk about that coming up next on The Real Investment Show. Don't go away.
You got it tough. I've seen the toughest around. When I know, baby, just how you feel. You got to roll with the punches and get to watch me. Why can't you see me standing here? I got my back against the regular.
You're listening to The Real Investment Show.
Welcome to the show this morning, 617. Danny Ratliff joining me this morning, live from his bat cave where he's laid up.
And I wish I had a bat cave. It wouldn't be so bad.
I know
Some gadgets and toys,
look,
right?
every guy wants a bat cave, right? And for years we've been trying to replicate the bat cave by moving into our garages. So it's not nearly as cool, but
If I don't start getting out of the house, I'm pretty sure I'll be sleeping in the garage. So,
probably.
Yeah.
Probably. All right. Coming out this morning, quite a few earnings announcements. Of course, like I said, we're really kind of in the heat of the moment. This morning, we got Six Flags Entertainment, Humana, Pfizer, Teledyne Technologies, CME Group. McDonald's just announced a few minutes ago, and of course, beat on top and bottom line. Moody's Corp, Boeing, General Dynamics, Bristol Myers, and Shopify coming out this morning. And of course, Shopify is one of those kind of smaller tech companies that are within the NASDAQ that you don't really see a lot about, but it's been one of the bigger winners since the COVID shutdown because people transitioning more to online shopping. After the market today, of course, is the big one, which is Facebook. They'll report after the bell today. They're expecting adjusted earnings of $3.53 a share and revenue of about $27.8 billion. Ford also out today. Of course, all eyes are going to be on Ford about their transition to their electric vehicle movement, right? So, what are they talking about in terms of how many pre-orders, how many sales, et cetera, of those vehicles? Lam Research, PayPal, of course, also after the bell, Xilinx and ServiceNow. So again, we're right in the middle of the kind of this big earnings season, week, and it's this week. And really kind of wraps up next week. But today, tomorrow, Thursday in particular are going to be pretty much all your big FANG stocks. Those are all announcing this week. And of course, that's really going to be part of the movement of the markets. And it's interesting because, again, normally when you see companies announce earnings where they're beating by large margins on top and bottom line estimates, usually you see stocks up, 3, 4, 5%, sometimes a whole lot more. Stocks really aren't getting rewarded for it because a lot of these earnings announcements have already been priced in to the stocks, right? Because there's already been such a big run up in a lot of the prices, particularly in these FANG stocks. And it was interesting. Last year, we were all talking about the value trade's back, right? We've got to buy value stocks. Value stocks are back. It lasted about 37 minutes because that whole value trade has now left the market, as money has now rotated back into the deflation trade of technology growth companies, which are companies that can generate lots of earnings even in the midst of an economic slowdown. And what this is telling you, and this is what we've kind of been alluding to, is that first of all, I've got an article coming out on Monday and then a sequel to it coming out the following Monday, talking about the fact that we just experienced peak earnings growth, peak economic growth. So from here on out, the rate of growth is going to slow back towards 2% or less, and a lot of this has to do with the debt. The other problem with that is, of course, that's also where revenue growth comes from for these companies and where earnings growth come from. And again, with markets having already run up a lot in terms of expectations, forward expectations are going to start to come down because this is probably the peak of the earnings growth for a lot of these companies. And this also has an impact from the fact that now we're starting to talk about, COVID cases coming back. Yesterday, President Biden talking about potential mask mandates for federal workers. Of course, more guidance from the CDC recommending even vaccinated people go back to wearing a mask. Even some talk about shutdowns, possibly, as we start to see cases rise of this of COVID again, despite the fact that you've got the vaccines, out into the population. So, that all has potential bearing and impact on economic growth. If we make decisions that are going to lead us to step back into our bat caves, Danny, that means we're going to be doing less, right? We're not going to be going out and eating. We're not going to go out to bars. We're not going to go out to restaurants. And here we go. We start to step back on all the things that we've done up to this point to try to get the economy back online. Danny, your thoughts?
Well, obviously, it's going to be extremely detrimental if that's the case. I mean, you start shutting everybody back in, and it's going to be interesting to see how that plays out longer term because we've talked about how, we see this big inflation push. And if you look at all the earnings calls as of recent, most CEOs have noted that there is some inflation that they're seeing, and they are concerned about the future.
Right.
So, you look at Starbucks, you look at any of these companies, regardless of industry, that seems to be a pretty prevalent sentiment. And so, looking at that and thinking about what we've looked at moving forward on how we could see some deflationary aspect, looking at the year-over-year numbers. Look, we've seen those transient, supply chain issues from an inflation standpoint. Now we're seeing some of the more permanent, where like last week we saw Unilever come out and say they're going to increase prices yet again. Some of these other companies, I believe, will follow suit. What does that do when you start shutting everybody back down again? And in fact, let's start thinking about some of the root causes of some of these issues was, factory workers not having employment, things of that nature. Where does that put us once again? How does that impact the overall supply chain? And what is the long-term outlook? I mean, that's a great question for you in the sense of, looking at the big picture, the macroeconomics behind it, probably much greater, and it's probably a much bigger question than, just what lies on the surface of, do we shut down again? Do we not? I think it's going to be difficult. I think that a lot of people this time will probably they're going to fight the system more often than not right now, right?
Well, I mean, I think you're seeing that a lot already. There's a good bit of hesitancy from a portion of the population to get vaccinated. And look, I mean, their reasonings are sound, right? I mean, you've got an untested vaccine. You've got, this, and it's not even a vaccine, right? It's a therapy. It's not even an actual vaccine. So there's a big chunk of the population that's like, hey, you know what? I'm just going to wait and kind of see what the effects of it are to see if there's any long-term side effects, et cetera. So, they can make a reasonable argument as to why they want to wait. Then you've got the other side of the population that's like, no, I'm getting vaccinated right now. Hey, great. That's awesome. And this is kind of your choice. But, this is, going to kind of lead back to this more concern about, well, why am I getting vaccinated if it doesn't protect me against, every variant that comes out? And, this is the whole situation with the flu vaccine, right? When you go get the flu vaccine, it covers you for basically 5 versions of the flu, and there's like 250 different variations of the flu. So, it's kind of a crapshoot whether or not you get the right type of flu that keeps you from getting, sick from and that the vaccine actually works. So, there's a lot of arguments, logical on both sides for the case, but it comes back down to the point is to how people react. And I think you're right, is that, with a lot of people now getting back their freedom after being locked down, for a year, and they're back out into the economy, I think there's going to be a lot of resistance now, even from people that are vaccinated, potentially about going back into lockdowns. I'm not saying that's going to happen. It's just kind of a mention, that was coming out in kind of the media yesterday, talking about the potentially to start trying to lock down some areas, maybe sporting events, these type of things where you're getting a lot of people together. Look, the NFL's just trying to get back, into action and, in Major League Baseball, and we're just trying to get people back into stadiums. I just think there's going to be a lot. My view is I just think and I agree with you, I think there will be a lot of resistance to trying to shut down the economy again. I don't know how you get there without having riots in the street almost at this point. But to your point about supply chain shutdowns, et cetera, that's going to be a bigger issue because, again, we haven't even repaired the supply chains that we have now. If you take a look at a lot of these manufacturing indexes, they're at record highs. And it doesn't mean that manufacturing is at record highs. Durable goods actually disappointed yesterday. These are survey comparisons about how do you feel compared to last month. And it's like, okay, well, I feel better, right? We're getting more orders in. Those are good. We're going to hire a couple more people. That's great. So that comparison and sentiment is at a record high for a lot of these manufacturing indexes. But again, now you're going to start to change that dynamic, and you're going to start having a retraction in a lot of these sentiment surveys, and that's going to have an impact not just on the economy, but on the financial markets as well.
Yeah, and that's the exact point, is what happens just the mention of a shutdown. I mean, we're already seeing, people kind of, upset about just a mention of a CDC mask mandate. You think about a shutdown, what does that do to the markets, more importantly, especially while we're at these all-time highs? Once again, we're seeing markets that are pretty lofty here. Like you've mentioned previously, price to perfection.
Yeah. It's just interesting kind of too as we kind of look, at this. One of the concerns is right now about, where is the next level of support, right, for the economy. And what I mean by that is that, we did all these bailouts and stimulus, and that was due to the reasoning of, well, we shut the economy down, we have to provide this. Well, right now, there isn't really a need to do more of those types of stimulus programs, right? We don't really need to do $1,400 checks to households. But if you had another shutdown, as an example, then that would give you good backing to pass another round of stimulus bills. And this is interesting when you're coming up on the fact that you're about to hit the debt ceiling limit here in the next month or so. And we're talking about passing, $3 to $4 to $5 trillion worth of a infrastructure package. And of course, now we're labeling everything infrastructure, right? Child care is now human infrastructure, right? So that way we can shove it to a budget bill. But what people forget is that budget bill is not just $4 trillion for infrastructure. It's $4 trillion plus the other $4 to $5 trillion just to actually run the government that we run on continuing resolutions every year. So we're talking about massive increases in debt. And what would really help smooth the tracks to get that passed would be another government-driven shutdown of the economy. Now, that's conspiracy theory for you. But I'm just saying, if you needed a push to try to pass the largest debt-issued, surge of capital in the history of the United States all at one time, that would certainly help smooth the process. Be right back after the break with Danny Ratliff. Don't go away.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So, Danny Ratliff joining me this morning, live from his lair, of course, as he's still in the recovery process. How's your healing process going? Another 3 months?
Oh, no. I hope not. Day by day, just taking it easy. So hopefully next couple of weeks, go back to the doctor here and get the go-ahead, the green light for PT. So looking forward to doing some physical therapy and actually being able to move my knee again will be a blessing.
Well, and this is what you get for trying to play basketball at your age. So,
yeah, among many other things. Yeah, absolutely.
Yeah.
Great reminder. I'm not nearly as young as I think I am.
Isn't that always the case, right? Yeah. So a couple of things. Speaking of athletics, Simone Biles, she, of course, stepped out of the Olympic Games for, mental reasons. Of course, I think there's a lot of things maybe more behind that. But, what does that have? You had an interesting point this morning that there's some interesting correlations between that and investing.
Well, I think it's really interesting. You look at Simone Biles, who is arguably the best gymnast the United States, arguably maybe even the world has ever seen. A powerhouse.
Especially when they're talking about where they're going to have to curve her scores to give everybody else a chance, right?
Yeah, and so she is so good. But something happened, obviously, internally where she had to take a step back and say, look, she is doing feats that are 10, 15 feet in the air. I know there's lots of controversy over this that's saying, well, she should be ready. You can't take a mental break here in the Olympics. There are many other people who are ready to go. But you also have to be cognizant of your own health. Right. And many times I think as an investor, we need to maybe take a lesson from actually Simone here in the sense of there's times that we can get over our skis, so to speak, and not be prepared for what may come. And so, knowing when you're too far ahead, I think in understanding when you need to take a step back, even some of the best pros will take a look at markets and say, hey, you know what, maybe now is the time for me to actually take a step back, understand what I'm doing, and go back to the rules and the disciplines that we set as an investor. And I think that this is a good reminder that even some of the best have to go do that and do that reset. And maybe you take a seat and you have somebody else come in. And so that's where I think we can make an argument of hiring a professional, looking for people for guidance, understanding exactly, what we're doing. So Anyways, I think it's an
but
interesting point. Lots
is,
of controversy with it.
Yeah, no, it is an interesting point because, when it comes to investing, I mean, there's lots of controversy with that too, right? There's an old adage in the financial markets. How do you make money in the markets? You sell high and buy low. The problem is the media never tells you to sell ever. So when markets are going up, it's like, got to keep buying, right? You're a new high. You buy, keep buying, right? Markets are new high. They're going up. Got to keep buying. But again, I think the point you make is good because we do need to step back and evaluate. I'm buying companies that I really have no idea what they do. And I have no idea what their earnings are. I have no idea where their revenue comes from, but they're going up. So I'm just buying them because I read about it on some Reddit chat window, right? Then, that's the point. I think you've got to step back here a bit and go, what the hell am I doing? Because it may be working now. And this is the one thing about bull markets that they typically become very brutal teachers, which is, during bull markets, you're forgiven for the investing mistakes that you make, right? So, whatever event you're doing, okay, let's take your basketball playing, right? You've been playing basketball for a while, felt a little pain here and there, but you're like, I'm fine, right? I'm just a little older. It's all good. And then one day you wake up and now you're laid up for, 6 months. It's the same thing in the market. The market, and during a bull market, the market will forgive you for those little mistakes and it'll bail you out. So, you buy something, it goes down and you're like, oh, that didn't work out quite right. But then it runs right back up. And you're like, oh, okay, so it's fine. Well, those little pains were telling you that there was something wrong with those investments. And then one day you're going to wake up and you're going to realize the mistakes of your portfolio. And this is the thing, right? Is that, the bull markets will forgive you for a lot of things, but if you don't start taking some action and cleaning up those mistakes and adjusting for those mistakes, there will be a point that the market doesn't forgive you for it. In fact, will punish you for it, and brutally so. And, that's one of those things that it takes a long time to recover from. But if we kind of listen to the pains and the aches along the way and say, okay, I've got a little pain, so I'm going to not do that for a while, or I'm going to change what I'm doing, then you can go through these periods without getting, majorly damaged. But that's the thing that we don't listen to, and, talking about Simone, it's a great example. It's not a decision that people like. And again, when you talk about selling and, markets are running up, so why are you taking profits, right? People don't like to hear that. If you say anything bearish about the markets, you're tagged as bearish, right? And, don't listen to them. They're bearish, right? Only listen to the bulls. That's confirmation bias. Nobody's happy about Simone stepping down, but maybe it was the right thing for her. And it might be the right thing for you to start thinking about the risk that you're actually taking in your portfolio and potentially what the outcomes are going to be.
Well, we hear so frequently that, everybody should, get out at the top, and maybe that's exactly what she's doing. And, it's easy to make money when everything is going up, but what do you do when things are going down? And do you step aside at that point? That's the one thing that most people can't do. You talk about the easy thing, sell high, buy low, but unfortunately, most people don't do that. If I had $1 for every time I've visited with a couple and, they're walking out of the office and the wife will pull me aside and be like, hey, we really need some help. He's never made any money. And we always do the wrong thing. And it's because it's emotional, right? Yeah. We think that, everybody's in, we need to make money while we can. And then when things go wrong, you think, oh my goodness, I can't, I'm going to work for the rest of my life. This is all we have. We work so hard for our family. It's our security. And so we'll bail. And it's human nature. And that's the hardest thing to fight, I think, when we talk about investing.
I know. And look, the reality is that everybody's got the plan, right? Everybody's got the plan that when this market rolls over, they're going to sell and get out. And Mike Tyson once said that everybody has a plan to get punched in the face. And that's the truth of the market, right? Which is everybody's got a plan. It's like, oh yeah, as soon as this market stops going up, I'll sell everything. I'll just go to cash. It'll be fine. No worries. But the reality is when the psychology kicks in and the market starts going down, it's like, okay, well, it's just a little correction. We've seen this a lot, right? We're at the 50-day moving average. Actually, I'm going to buy some, right? Because we're at the 50-day moving average. And then it starts to go down some more. And you go, okay, well, as soon as it gets back to the 50-day moving average, I'll sell that so I can break even on what I just bought. And then it goes down some more. And then you say, well, okay, well, as soon as it gets back, as soon as it bounces a little bit here, then, I'll sell some and I'll get out. And then it gets to the 200-day moving average. Like, okay, well, we're at support now, so I'm going to buy it. And so you buy it, you put a lot of money in the market, the 200-day moving average, you're convinced that that's the bottom, and then it goes lower. And this is the psychological trap. And again, when the market starts to punch you in the face, the best laid plans go right out the window. and especially when it's Mike Tyson that's hit you in the face, that typically happens. But this happens to investors repeatedly, and this is all psychology. And this idea that you've got control over markets, you don't. And this is, as soon as you get caught in that site, that as soon as that market corrects, and your first instinct is to say, well, as soon as it gets back, you already lost, right? You're in the trap as soon as those words come out of your mouth. And that's where everybody winds up to eventually, and why people lose so much money in markets when you do get corrections. But Danny, we don't have corrections in markets anymore, so don't worry about it.
Or fundamentals, for that matter.
Or fundamentals. Roth IRA for kids. Fidelity now starting this one. Now, I got a question about this. Don't you have to work to contribute to a Roth?
You have to have some type of income, but it could be from street sweeping. It could be from babysitting. I mean, there could be a number of different ways that a child could have some income.
So basically, I could give my kids money and say it's for allowance, and then they could put that into the Roth IRA.
Yeah, I'd certainly visit with your CPA. I'm sure there's a little bit of gray area there with that. But, most kids aren't even filing tax returns.
Right. Well, that's my whole point is that the Roth IRA and the IRA, right, that's all earned income, right? So you have a W-2 or a 1099, whatever it is, to back up that income. So I'm just trying to figure out how do you get around the tax rules to create a Roth IRA for kids that aren't of legal age to work.
Well, look, if your child had, say, $5,000 of income, you're probably not filing a tax return.
Right.
The issue will be is that if the IRS ever came in and audited your child, and there was supposed to be a 1099 filed, this could become a nightmare in some of these aspects. Now, granted, this probably doesn't happen as often as what most people would think, but there is the ability for you to go out and actually utilize a Roth IRA for kids. And I think it's a great way to get somebody started. And I like the aspect of it as well, is because these funds are truly intended for retirement. They're not just an account that's a 529 or another account that, where you're just putting funds aside that they have access to, like a uniform transfer to minors account. This is purely for retirement. So if you can do so, I'd visit with your CPA and see if this is an option, because this is a great way to get your kids started on the right foot for retirement. And, it's like you've seen all these charts. My dad used to show me this like every other week when I was little. Like, hey, if you put $2,000 every year and you made 8%, but obviously that 8% was stagnant. It was always 8%. Rule of 72, you're going to have, $2 million.
Right.
And,
sounds great.
You show the chart from when you're 18 to 30, and then you stop investing. And then when you start at 30 and you invest all the way till you're 60, when you're 18 to 30 and you stop, that actually made more money. However,
what's interesting though is this sets up great party tricks. So I'll be available. So if you do this, I am available to come to your house dressed up as an IRS agent to audit your kids. That way we can teach your kids the value of an IRS audit at the same time.
now you're talking, right? So.
All right, be right back.
We have to be careful. You have a 1099 for that side gig, though, Lance.
Exactly. Be right back after the break. Don't go away.
Trying to make ends meet. You're a slave to the money and you die.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Everybody get up!
Take your questions and comments here, of course. If you're watching our live stream on our YouTube channel, feel free to go by there, jump into the chat window, join the conversation, ask questions, comments, and one of the best comments this morning is Danny will do anything to keep working from home. So that is probably the case that we're going to have here for a while, for sure.
Well, you guys have set me up here so nicely. It's been great. Like, hey, we could do the radio show from anywhere. Oh, no. You need to come to the studio. And now, I mean, look at this. It's great.
Yeah, no, right. Too funny. Anyway, so a few questions on our YouTube channel. One, kind of really talking about fundamentals, and it's kind of interesting when you talk about fundamentals coming into play. It doesn't really seem like fundamentals matter much anymore, right? I mean, we talk about things like price to sales, price to earnings, and it's been such a long time now that the market's just kind of risen. I mean, we're up 100% from the lows of 2020. I mean, you've had a massive run in the markets just in the last 15 months. It's been just quite phenomenal, and there's nothing wrong with that. But what it does is it starts to push investors to the point where it's like, oh, fundamentals don't matter. There was an article. I'm gonna write an article, kind of a rebuttal article here soon. But there was an article by Mark Hulbert over at MarketWatch recently saying that valuations don't really work anymore, so we need to modify the way we look at valuations. Well, that's wrong. Valuations do work. They just may not be working at the moment because we're choosing to ignore them. It doesn't mean that valuations are broken. And this is the problem that we run into when we start trying to rationalize what markets do and say, okay, well, this time is different because of low interest rates. Well, there's nothing in history that shows that low interest rates justify high valuations. In fact, it's exactly the opposite. Every time in history we've had low interest rates and high valuations, bad outcomes have happened for investors over the next 20 to 30 years. It's been very brutal. Post 1929, 60s and 70s. I mean, it's just been quite brutal for investors. And so we keep trying to come up with all these new excuses why this time is different. It's not. It's not different. It's just different at the moment. And this is kind of one of the questions I'm getting a lot lately by email. So if you go by our website and have a question, simply click the Ask a Question button. We answer every question every day, realinvestmentadvice.com. But I'm getting a lot of questions lately about, well, I've got a lot of cash. Should I invest it? What should I do? Should I just put it under a mattress? No, you've got to invest for where the markets are right now. The markets are going up. We need to make money. We need to invest. Our portfolios are nearly fully invested. We are holding a little bit higher levels of cash at the moment, but when we were fully invested, actually we were overweight equities earlier this year, and we've reduced that here recently just to hedge our risk a bit. But we have to participate with markets because we've got to make money for our clients, and this is one of the problems we run into, is that we allow our emotions, which is, oh my gosh, the market's overvalued, I can't invest here. Understanding that valuations can take a very long time to play out, we have to invest. The question is how do we do it and mitigate risk? And that's where, as you were talking about early, Danny, this is where having rules and a discipline and approach and these type of things in place allow you to navigate the markets for what they are rather than what we want them to be. Right?
Well, that's right. I mean, if we looked at prices, we could be in the bunker for the last several years. I mean, that's a difficult argument, and that's one that we hear daily, is that, look, I've been on the sidelines. I know I need to invest, but I just don't feel like right now is the right time. We let our emotions get in the way, and there's been people who've been in the bunker for years. But I think what you said matters the most is having that strategy to get out when needed, or to reduce and mitigate risk by reducing that exposure. I mean, that's going to be key. Having cash on hand when you do get those opportunities to actually utilize those funds to invest, which so many people don't, because you're fully invested at all times. You don't have that opportunity to take advantage of those ebbs and flows in markets. And I think that's one of the important parts of it. And then also that capital preservation, obviously, number one, I think that's just so crucial. And then understanding what is somebody's real goal. I think we've been distorted with markets the way they've been, and then this big advertising push of, hey, just invest in the ETF, don't worry about it, set it and forget it. But we've long forgotten about how cycles work and what actually happens, the negative consequences of writing something all the way down. And furthermore, writing it down and being in retirement and needing it to take distributions. Now you're never getting back to even.
Right. Well, and that's kind of the point earlier in the show today. We were talking about, we've got record inflows through the first half of this year. We've got record inflows into ETFs greater than any other full year in history, right? So by the time we finish this year, if everything keeps going the way we're going, this is going to be an unprecedented flow of capital into ETFs. And look, there's nothing wrong with ETFs, right? This whole idea of passive indexing is fine. As long as markets are going up. But what people forget is this is leverage in the markets. It's an unknown leverage, but it's leverage nonetheless, because an ETF is simply an instrument of underlying individual stocks, or potentially underlying ETFs that are ETFs of other stocks. So eventually, if somebody starts to sell these ETFs for any reason whatsoever, and people are selling Apple at the same time, right? So most of these ETFs own Apple. And so if something's going on with Apple and I'm selling Apple, and then all the ETFs that own Apple start selling the ETFs, you're going to get a magnified selling pressure on those underlying companies, which will exacerbate the downturn in the markets, and it will create a liquidation event like we saw in March of 2020. And this is why you had a 35% correction in a month, right? Bear markets normally take several months. They take between 8 and 12 months normally for a bear market to complete itself, sometimes a little bit longer. We did a full bear market, 35%. Actually, it wasn't technically a bear market. It was a big correction, but we had a 35% correction in 3 weeks. And that was because once those ETFs started to liquidate, it liquidated all the underlying securities, and you had this massive outflow of capital all at one time. And that's the real risk here, is that going forward, because of these ETFs and because of this idea of passive indexing, is that bear markets are going to be more brutal and swifter than we've ever seen historically. In other words, bear markets occurring over a function of 1 to 3 months is probably going to become more the norm than what we've seen historically. And the problem with that is that investors have no opportunity to get out of the markets, because as you saw back in March, we had one bounce that lasted 2 days in that entire decline, and then the market went straight down to the bottom. And we were down 4, 5, 6% day after day after day. There was simply, investors going, hey, if I get a bounce here, I'll sell out. They never got a bounce to sell into. And really, you just got to pick your point and say, that's where I'm out, and I'll figure it out later. But that's why most investors got swept up into that full decline, because there was never an opportunity for them to exit the market safely.
Well, and I think, though, this a little bit misleading. What happened last year is that, we saw one of the quickest recoveries as well. You that 3-week bounce, and then you see this recovery that happened so quickly. Investors were bailed out. In fact, Rich calls it the Yogi Bear market. The Fed came along with a picnic basket and helped everybody out. And will that always be the case? That's going to be a tough argument to make. And then you don't have that true price discovery where we can go through and sift through the rubble because everybody's been liquidated. And then you can find some really good companies at good prices. That's, I think, where this thing gets a lot more fun on our side of the table from an investing standpoint. When not just, look back at last year, a lot of the things that went up was pure junk.
Right.
You couldn't make an argument to go buy half these companies.
But again, you didn't have to, right? And this is the one thing that we've trained the investors to do very well, is like, as soon as the Fed shows up, buy the worst possible fundamental companies, because those will go up the most because of speculation. And the question is going to be, this is going to be an interesting situation for the Fed, is they're at zero interest rates, so they can't lower interest rates anymore. They're already doing $120 billion a month in QE. If something breaks in the markets now, what are you going to do? And this is one of the challenges the Fed's going to face here over the course of the next few months. And one of the biggest risks to the markets is they've got to some point figure out how to start extracting themselves from QE, so they can have QE available for whatever the next event is down the road, because there will be another event, for whatever reason. And it will be driven by the Fed. It's always driven by the Fed. But they've got to start putting themselves in the positions for that, but they really can't at this point, because now they've got themselves socked into this corner of, well, we're not, we want full employment at 3%. We want inflation to run hot, and hey, you're getting it all, right? You're getting dropping employment rates. You're getting inflation running hot, but now the inflation's running hot. It's like, oh, well, don't worry, it's transient. Well, now you're in the box, right? You've now pulled the investor mistake. As soon as the price rallies back, I'll sell it. Now the Fed's in a box of, well, it's not really inflation, it's just transient. So I'm going to keep doing what I'm doing that's causing the inflationary pressure, right? And this is going to be an interesting box that they have to try to extract themselves out of over the next few months.
And I think that we're seeing price creep along many different staples and items that we historically haven't seen much price increases over, where you're seeing 15-cent, 20-cent moves that you probably don't realize if you're just pulling something off the aisle, but once you get to the register and it all adds up, it starts to become rather significant over time.
Yeah, no, it actually does. I mean, food costs are definitely going up. Gas costs are up. Housing costs up 18% in a month. There's no inflation, though. Don't worry about that. New cars are selling at the same price as used cars now. So,
look the other way.
Yeah, exactly.
I think there was less than $1,000 difference between a new car and a used car on average.
It's crazy. Why would I buy a used car? Anyway, all right, wraps up the show today. Danny Ratliff, thanks so much. Of course, get by our website, realinvestmentadvice.com. The latest article from Michael Leibowitz is out on the website this morning, actually talking about inflation. That's on the website. Stick around, though, on our YouTube channel, because 3 Minutes on Markets and Money will be coming up here soon. And stay tuned, because hopefully by the end of this week, we're going to have our brand new website up and launched. So we're just through the final few little tweaks on that. That's all coming your way at realinvestmentadvice.com. We'll see you tomorrow.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a